This question tests understanding of short-term liquidity analysis, specifically the difference between the current ratio and the quick acid test ratio. Liquidity ratios measure a company's ability to meet short-term obligations using current assets. The current ratio equals current assets divided by current liabilities, while the quick ratio equals cash plus marketable securities plus accounts receivable, divided by current liabilities, excluding inventory and prepaid expenses. The key concept is that not all current assets are equally liquid. Cash and receivables can usually be converted into cash quickly, whereas inventory may require production completion, transportation, and sale before generating cash. Inventory may also become obsolete or require price discounts, making its value uncertain. Therefore, analysts often prefer the quick ratio because it provides a more conservative measure of immediate liquidity. A. Quick ratio excludes accounts receivables. Incorrect. The quick ratio includes accounts receivable because receivables are expected to be collected within a short period. B. Current ratio includes marketable securities which may be mispriced. Incorrect. Both the current ratio and quick ratio generally include marketable securities, so this is not the distinguishing factor. C. Pro forma cash flow statements focus on cash only. Incorrect. Pro forma cash flow statements are unrelated to the difference between the current and quick ratios. D. Conversion of inventory into cash is less reliable. Correct. Inventory is the least liquid major current asset and may not be easily converted into cash at its recorded value. Excluding inventory makes the quick ratio a better indicator of immediate liquidity. Correct answer, D. Conversion of inventory into cash is less reliable. This question examines the ability to calculate the quick acid test ratio, an important liquidity ratio used to assess whether a company can meet its short-term obligations using its most liquid assets. Unlike the current ratio, the quick ratio excludes inventory because inventory may take time to sell and may not always be converted into cash at its book value. Students should identify which assets qualify as quick assets. Cash, accounts receivable, and marketable securities are included because they can generally be converted into cash quickly. Inventory is excluded, and long-term liabilities are irrelevant because the ratio measures short-term liquidity against current liabilities only. Calculate the quick assets. Cash equals $531,000 accounts receivable equals $439,000 marketable securities equals $200,000. Total quick assets equals $1,170,000. Current liabilities equals $500,000. A. 1.25, incorrect. This understates the quick ratio and likely results from excluding one or more qualifying quick assets. B. 1.94, incorrect. This value reflects an incorrect computation of quick assets. C. 2.34 correct. It is obtained by dividing $1,170,000 of quick assets by $500,000 of current liabilities, giving 2.34. D. 2.94, incorrect. This likely results from incorrectly including inventory as a quick asset. Correct answer, C. 2.34. The quick ratio of 2.34 indicates that the company has $2.34 of highly liquid assets available to cover each $1 of current liabilities, suggesting a strong short-term liquidity position. This question tests the accounting impact of purchasing merchandise on credit and its effect on working capital and liquidity ratios. When inventory is purchased on account, the company records an increase in inventory, a current asset, and an increase in accounts payable, a current liability, by the same amount. The accounting entry is debit inventory credit accounts payable. Students should evaluate how this transaction affects each financial measure. Total current assets increase because inventory increases. Total current liabilities increase because accounts payable increases. Net working capital, current assets, current liabilities, remains unchanged because both increase by the same amount. Current ratio, current assets divided by current liabilities, generally changes because the numerator and denominator increase by equal amounts but proportionally different amounts. Unless the ratio is exactly 1.0 before the transaction, the current ratio will change. The key idea is that equal increases in current assets and current liabilities leave their difference unchanged but usually alter their ratio. A. Total current assets. Incorrect. Inventory is a current asset, so total current assets increase. B. Net working capital. Correct. Net working capital equals current assets minus current liabilities. Since both increase by the same amount, the difference remains unchanged. C. Total current liabilities. Incorrect. Accounts payable increases, so total current liabilities increase.
D. Current ratio. Incorrect.
The current ratio is generally affected because both the numerator and denominator change, altering the ratio unless it was initially 1-to-1. Correct answer, B. Net working capital. Key takeaway: purchasing inventory on credit increases both current assets and current liabilities equally, leaving net working capital unchanged, while the current ratio is usually affected. This question examines how purchasing merchandise on credit affects the current ratio, a key liquidity measure used to assess a company's ability to meet short-term obligations. Initially, current assets equals $7,500,000, current ratio equals 2.3. Therefore, current liabilities are $326. When Davis purchases $750,000 of inventory on credit, both current assets, inventory, and current liabilities, accounts payable, increase by $750,000.
New current assets.
New current liabilities. New current ratio, 2.06. Since 2.06 is lower than the original ratio of 2.3, the transaction reduces the current ratio. This occurs because the company initially had more current assets than current liabilities, so adding equal amounts to both sides lowers the ratio.
A. Remain at 2.3 times. Incorrect.
Equal increases in current assets and current liabilities generally change the ratio.
B. Be higher than 2.3 times. Incorrect.
The ratio actually declines after the purchase.
C. Be lower than 2.3 times. Correct.
The recalculated current ratio is approximately 2.06, which is below 2.3. D. Be exactly 2.53 times.
Incorrect.
This result is mathematically incorrect. Correct answer, C.
Be lower than 2.3 times.
Key takeaway: when the current ratio is greater than 1, purchasing inventory on credit reduces the current ratio because current liabilities increase proportionally more than the liquidity benefit provided by the additional inventory.